Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. And I think we're basically counting down to the end of the year. 19 trading sessions left to wrapping up 2025. It's getting quieter, both globally and, of course, here in India. It's been sideways and very, very quiet. I'm Prashant. With me, my colleagues Nigel and Suri. Guys, morning.
Hi, morning.
Hi, morning, folks. So once again, global picture is pretty okay. Not too many wild headlines. Obviously, the all-important visit, Russian president in the country, President Putin's visit is going to be highly tracked. But from the market perspective, I think we need to get over some of our own internal issues. Rupee, FPI selling, that's still a bugbear.
Well, that's right. Even I was counting down to the end of the year, and then suddenly the JSW Steel deal came out of nowhere, woke me up and kept me busy all last evening. But we'll talk about that as well. Big deal coming in there, not just for the company, for the industry and for the nation as well, because you get $2 billion of money that's coming in from the Japanese partner.
And it is a CNBC-TV18 exclusive.
True that.
Which has been confirmed with the deal which has happened. So I think, there is that as well. So double dhamaka. We'll talk about this, as Nigel said, in greater detail as we move forward. But let's just quickly run you through what you need to know as we begin a new trading session. So US equities higher, and labor data came through. The private payrolls number came through, and that's fallen short of expectations. It's reinforced expectations of a Fed rate cut in December. I mean, it's, I think, by now like a foregone conclusion that next Wednesday, the coming Wednesday, the Fed will cut. In any case, I mean, this helped at the margin. US final close, S&P 0.3% higher. NASDAQ was up, just a little bit by close. Now, the ADP private sector employment fell by 32,000 in November. The consensus was for a dip of 10,000. So weaker labor market, furthering hopes that maybe there is a rate cut coming. 10-year yield was down 3 basis points to just around 4%. Oil, went down 1%, went up 0.6%. So not very much here in terms of some of these macro markets. Dollar index took a bit of a dive, 0.5% lower to about 98.86. Again, on the dollar for the last many weeks, we've not seen any movement. There's a Financial Times story, which, of course, I think there will be a fair bit written and spoken about this one, which is, of course, Trump basically publicly signaling that Kevin Hassett is the next Fed chair when Powell retires in May of 2026. The story said that bond investors are warning U.S. Treasury over picking Hassett as the next Fed chair, essentially the concern being that he's going to do Trump's bidding and cut rates aggressively and in a pretty dramatic fashion, which is not going to be great. So we'll, as I said, I mean, we'll get a lot of feedback, a lot of stuff. And of course, I mean, the question remains whether this one person, of course, very powerful, but not all powerful, the committee which sets the rate, and there are enough dissents out there as well. Just a couple of stocks, right? And Microsoft, and I'm just putting this out because there's all this talk about AI and whether the AI is, there's too much investment, etc. Microsoft, there was a report which essentially said that Microsoft is cutting back on, some sales quotas for AI products. Microsoft denied it, and the stock recovered from the lows. After our Salesforce reported numbers, and they reported a better outlook as well, and shares are up 6%. Just tying in the levels, the Nifty yesterday basically broke the 20-day moving average and pretty much is sitting on the 20-day. 25,942 is the 20-day now. And yesterday's candle is basically crisscrossing the 20-day, and we are slightly above it. So that's a support on the Nifty Bank. 58,848 is the 20-day moving average for the Nifty Bank as well. GIFT Nifty gives you a quick sense of how we likely to start, and we'll pick it up from there as we move forward. 56 points lower is what you have. F&O positioning, what's it looking like? Nigel, over to you.
Well, it was good to see the Nifty as well as the Nifty Bank go ahead yesterday and defend the 20-day MA. And today we have the sensex weekly expiry that will play out. So that will add an element of volatility towards the end of the trading session. On the global front, two positives are that the dollar index is very, very well behaved. Good for emerging markets, good for India as well, though we've not got our share of the flows. And Brent crude prices as well are closer to around $60 per barrel. Cannot ignore both these two positives. That's positive from a longer term perspective. The FIs, they continue to sell. We're getting used to them selling closer to 3,500 crores odd. You'll want that number to come down as we saw a couple of weeks ago. Net though, the institutions, they are biased because the DIs, they make up what the FIs are selling. Moving to the futures data then, you have the FIs that have added shorts, both on index futures as well as on stock futures, and there is some unwinding of long positions. So in a market that's stabilizing or consolidating, you want shorts to get into the system because at some point of time, these shorts may not get follow through on the downside. That's the optimistic way of looking at it. So you'll want some shorts in the system, and if you wanted that, you've got that up for you in the screen. In fact, in the last few trading sessions, if you pull up a chart, the FI short positioning, that's moved up from close to around 87,000 contracts odd. That's moved to around 1.1 lakh contracts. So effectively, it's up by close to around 25%. The short positioning from the FIs, and you wanted shorts in the system, that's what you've got. The clients on the flip side, they have gone ahead and they've added long positioning. So that's up by more than 50%, from around 55,000 contracts. Now they're at around 93,000 contracts. FIs net short, clients net long. That's a combination actually that normally spells better times. But let's tell you about the other data points then. The PCR, well, that's, come down a little bit. And yesterday the market ended low. The index, the India VIX as well, that cooled off. You don't want the VIX to spike up, and that's precisely what's taking place. Let's run you through some of these data points now. The call writing, that's come back, which is the reason why the PCR has come down. So you get aggressive call writing, both at the 26,000 call, 26,100 call, close to 80 lakh shares getting added there. So let's punch in the levels. You've got a broad range. Downside, 25,900. That tallies when yesterday's low. And on the upside, the recent high as well. So that's the broad range that you're looking at in terms of support. 20 DMA and yesterday's low. That's important to track. And the Nifty Bank as well, you'll want to defend the 20 DMA. So that's the important mark. A stock that I'll be looking at actually is JSW Steel because, it was a CNBC-TV18 exclusive. But going by the detail that the management had put out till the time the market shut, the street was working with an enterprise value of around 35 to around 37,000 crores odd. However, the enterprise value is much higher. So this stock will react positively to kickstart trade today. That's a stock I'll keep on my radar.
Okay, JSW Steel absolutely is going to be on our radar. Let's see if the market is more convinced now that we have more details emerging from that JSW Steel JFE tie-up for Bhushan Steel and Power. Moving on, Asian markets actually are a bit of a mixed bag this morning. Of course, there is some amount of optimism that's coming in from Wall Street. The hope that we will indeed get a Fed rate cut when the Fed meets for the last time this year next week. But there's also some profit taking in some of the regional markets. Like you're saying, Japan's doing very well. It's up about 1.5%. And by the way, let's not lose sight of silver. It's now closing in on the $60 handle, 59 to 60 almost. I was hitting yet more fresh records yesterday in overnight action. For the time being, let's actually look at the equity call of the morning. Aditya Suresh of Macquarie says, following a steep 25% underperformance against MSCI EM, so far in 2025, they are revisiting the building blocks of their top-down market view. They've turned more constructive and expect relative performance to be driven by a revival of India's earnings growth and, in turn, a resumption of foreign inflows after a 5-year hiatus. He adds that further top-down support comes from India serving as a hedge on the intensifying global AI theme and a thawing of US-India relations. So that's a view coming in from Macquarie that India is emerging as a bit of an anti-AI trade, as well as, of course, there's hope that earnings will pick up, driving FPI flows next year. Let's move on then and welcome our first guest on the show. Richard Yetzka, Group Chief Economist at ANZ Research, is with us. Richard, thank you so much for joining in. What's your sense? Let's look at the big market, the mother market first up. I think it's a near consensus that the Fed will deliver a 25 basis points rate cut tomorrow. We'll know more on the inflation figures as well. The September PCE data will be released later this evening. So from that perspective, are you expecting largely the US equity rally to remain intact? And if yes, and what are the implications for Asia?
You're right to say that everyone expects the Fed to ease, but of course 2 weeks ago that wasn't the case. The market was very much at sixes and sevens about what the Fed would do. So this has been a new development, and the broader market, of course, hasn't really shown the same shift in conviction. I think the market call remains an AI-related issue, and that's a bit separate from what's likely to happen on rates. And in fact, the broader economy in the US is looking like an economy which has some tariff challenges. The activity numbers have tended to be a bit softer, certainly not terribly so, but the trend has very clearly been in that direction, particularly on the hiring side. And inflation still seems like it's a little bit sticky up towards 3%. The Fed's view, obviously, is the inflation numbers will come down over time, but I think it's going to take some evidence as we get into 2026 for the Fed's view to be validated before we see some more easing.
Got that. Richard, the other big talking point here for India is, of course, the trade deal with the US, or the lack of one so far. We've got an important state visit. Russian President Putin is in India, and he's landing today evening. It's a 2-day visit. So assumes all the more significance, importance with what's been happening or not happening with the US. How do you think about this entire thing, Richard?
Well, I'll leave the subtext and who's meeting who and when to the experts. What I might say is, if you put all of that together, India does look a little bit different from some of the other parts of Asia, where even if the trade agreements might not be viewed all that positively from a domestic perspective, at least the economy and business can kind of get on because there is a trade agreement in place with the US, even if the details have to be worked out, and look to 2026. Obviously, India is in a slightly different position. And my sense around the region is economies where you've been able to get a trade agreement in place has brought a certain degree of certainty, or at least reduced the uncertainty around conditions. And that may be one of the things which is a factor that's holding the markets in India back a little bit.
Absolutely, and we really need to see what happens, because if indeed there are more defense deals for the S-500 defense systems or for these Su-57 fighter jets, and if that happens, how the US reacts, I think those are points of concern, and we'll have more answers over the next couple of days, Nigel.
Well, that's right, Richard. Let's wind this down then. In terms of the Indian markets, I think the last time we chatted, you said maybe things look better for the Indian markets in 2026. Domestic money out here has been coming in, but the FI money has stayed away. You think we get flows in 2026, as well as the Indian markets get back to outperforming, which we got a little bit too used to?
I think they will get flows at some stage. Of course, the dominant equity dynamic has been this huge AI story, very US-centric, but also very North Asia-centric. The strongest markets in the region this year have a real tech-heavy flavour. Hong Kong, Korea, Japan, Taiwan, India offers something different. So I think next year, if we maybe can see some return to reasonable expectations about what AI is likely to deliver, I think the Indian market comes back into its own. And also, of course, since we last spoke, we've had these incredible GDP numbers in India. I mean, maybe we should take things down a bit. When GDP said the economy was growing below 6, probably not quite right. The economy at 8 or more, probably not quite right. But somewhere even below that is still, I think, a really solid outcome in a world which is really struggling for economic growth. I think that'll be a feature of the Indian story in 2026.
And Richard, very quickly, last 10 seconds, the currency, the Indian currency, would that be a concern? You seem, fairly optimistic on the growth, whatever that number is. Is the currency fall, will that be a concern for investors?
Look, I think the currency story is a 2025 story. I think the rupee, it has a weaker bias, but I think 2026 will be a much better year for it.
Okay. All right. Good to know. Thank you so much for that. Good to get that perspective. You have a fabulous rest of the day, and we look forward to connecting again soon.
Thank you.
Well, one of the big stories of the day, obviously, is Russian President Vladimir Putin's visit to India. He's all set to arrive in New Delhi today, and the visit kicks off with a state dinner, which, of course, will be hosted by Prime Minister Narendra Modi. So what are the major things on the agenda? Will we see more defense deals? Will we see a rejig of the trade ties? Let's go across to Parikshit for the latest. Parikshit?
India and Russia are all set to bolster economic ties as President Putin arrives in New Delhi on a state visit. This will be Putin's first official trip to India since the war in Ukraine began in February 2022. The two-day visit is scheduled to begin with a private dinner on Thursday at Prime Minister Modi's residence. The leaders are likely to discuss a free trade agreement which will be signed in future. So what does New Delhi want from Moscow? First on the agenda is boosting exports of pharmaceuticals, agriculture and textile products. India is also looking for stable fertilizer supply chains with Russia, along with higher exports overall. The two nations are also likely to sign an MOU on migration to enable mobility of skilled workers from India to Russia, and also boost connectivity between the two countries, which will help trade. Non-tariff barriers, regulatory impediments, defence co-development and export of defence equipment, including the BrahMos, to third countries will also be discussed. Remember, trade between India and Russia stood at $69 billion in FY25, with India importing $64 billion worth of goods and services. So clearly, India would want Russia to buy more and bridge the trade deficit.
Okay, well, Parishit, thank you very much for that. And this is an important state visit. Lots of attention, focus will be on that one as we sort of move forward over the next couple of days, especially. Let me just quickly run you through the interactions which are lined up here on the program. 9 o'clock, we'll be joined by ICICI Securities' Vikash Singh to discuss the JSW-JFE deal. 9:20, Ashwini Agarwal of Demeter will take us through what he's making of markets now, quietened down sideways for a while. 9:35, IRFC management joins us to talk about them securing a $300 million loan from SMBC and, of course, the outlook going forward. We've got a discussion coming up on, the story that we did yesterday with regards to, the eligibility criteria for participating in the F&O segment. That's our colleague Yash's story, and we have a discussion planned at 9:45 around that. And Natha will discuss the outlook on the Indian rupee with Goldman Sachs' chief FX and EM strategist Kamaksha Trivedi. That's coming up at 10:15.
Time to slip into a short break. We go full tilt on stocks in our special top 10 segment. On the other side of this break, we'll look at JSW Steel, Biocon, Petronet LNG, JK Cement, Godavari Power, IX, Railtel Corp, RVNL and Pine Labs. All of them will be reacting to positive news flow, while Interglobe Aviation will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. Let's quickly look at what's happening with the GIFT Nifty and the implied open, because Asian markets are mixed. Like I mentioned, there's some profit taking in Hong Kong and mainland China, but Japan is up. So it's all over the place right now. 50 points lower on the implied open. It was a tough session even yesterday. We barely managed to hold on to 25,900. So let's see. There was a last hour recovery. Can the bulls build on that? That's the question. But now it's time to talk stocks, and there's plenty on our radar this morning. So we have the whole team standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Nigel, you go first. JSW Steel, what do you make of it now?
Well, going with green out there. Remember JSW Steel and JFE, that deal was announced yesterday, the 50-50 joint venture with JSW Steel, for the transfer of the BPSL integrated steel facility, which has around 4.5 million tons, which can scale to around 10 million tons. The total amount that JFE will be putting in is around 15,750 crore rupees in 2 tranches. Now, JSW Steel should bounce back. Let me explain why. The management explained that the enterprise value is actually 53,100 crores. When market closed, the street was working with a number of around 37,000 crores. And the whisper was 50,000 crores. So the street obviously was disappointed. But now they're explained that JSW Steel, they'll be transferring the asset from their books for around 24,000 crores approximately. So that's 24,000 crores. You add to that 5,000 crores of debt that is currently sitting in BSPL. So you're at around 29,000 crores. Then you get the second installment from JFE, which is another 7,000 crores. So ballpark, you're at around 37,000 crores in terms of a deal value. Plus, JSW Steel still retains 50% stake in BPSL, which is valued at another 16,000 crores. Short point is the enterprise value actually is 50,000 crores plus, and that is something that will please the street. So what changes for JSW Steel? Net debt reduces by more than 45% at the cost of a consolidated EBITDA number of around 11%. So that trade-off will take place. And brokerages like it. Nuvama says the deal is likely to enhance JSW Steel's fair value by 37 rupees. Motilal Oswal says the development will support JSW Steel's deleveraging plan. The net debt to EBITDA, they're expecting it to come down from around 3 to around 1.7 by FY27. So they reiterate their buy rating. They have a target price of around 1,350. And CLSA, though they have an underperform rating, they're estimating that this will lead to a sharp reduction in JSW Steel's leverage and so a value accretion of around 30 to around 70 rupees. Net, that enterprise value at 50,000 crores will make the street happy. The stock may not run away, but expecting a bounce back to kickstart trade for sure, because now it's value accretive.
Okay, all right. So that's JSW, and we'll see if the stock recovers today after that. Thanks, Nigel. Let's get to Ekta. She's watching out for some developments at Biocon. Ekta, tell us more. Morning.
Well, yes, the buzz was on yesterday and they did announce it post-markets where there will be a board meet on December 6th, Saturday, to consider an investment in Biocon Biologics, which is basically their biologic subsidiary. And this would be by way of purchase of acquisition of securities from shareholders of Biocon Biologics. They will also be considering raising funds via QIP, rights issue, preferential issue, or a public offer in one or more tranches. Remember that the reason for that is because of the debt that Biocon has on its books. Biocon has around $1.2 billion of debt on its books, which it's been trying to, sort of clear off since the past couple of years. It did acquire Viatris's biologics business in 2022, and since then it has been one of the key focuses of the company in order to reduce debt. Now, the company separately, remember, a couple of weeks ago had mentioned that they've constituted a committee to look into the merger of Biocon Biologics and Biocon, though this board meet intimation doesn't talk about that specifically. If you just look at the history of Biocon, they have been looking at fundraising, have been undertaking fundraising continuously. So, for example, they raised 4,500 crores via QIP in June 2025. They've been selling stake in Syngene continuously. For example, they sold 1.19% stake in December 2024. They sold close to 10% stake in Feb 2023, 5.4% stake in September of 2022 as well. So this is something that the company has been focusing on. It will be in order to reduce that burden of around $1.2 billion in terms of debt, something that Kiran Mazumdar-Shaw has told us repeatedly.
Okay, all right. Thank you very much for that. That's a big deal. As Ekta said, the chatter was there. The exchange release came yesterday evening. More on this later. It's an important story. Now, lots of flight disruptions yesterday evening. Indigo was one airline, which, of course, was at the heart of that. A lot of angst, flyers, passengers, etc. And Shivani is here to tell us what happened and is some of the problems still continuing. Shivani, good morning.
Good morning, Prashant. I think a problem is an understatement when it comes to what happened to Indigo in the last 2 days. Now, it is a disruption that has taken the entire country by a storm. All major airports have been hit by this. Let me give you some numbers. On Tuesday, day before yesterday, a total of upwards of 100 flights were cancelled. And yesterday till 6 o'clock, we are sure that there were 130 plus flights that were cancelled, and delays mounted up at least 4 to 5 hours at major airports, which includes Delhi, Mumbai, Hyderabad, and Bangalore. Now, what has happened, Indigo has come out with a statement that there were a lot of operational issues at their end, which also included weather changes, weather rostering, and also the FDTL norms, which is the mandatory rest timing norms for the pilots. So that's the major and key issue over here. DGCA also last evening came out with a notice, and they've summoned the airline now. They've also given data for November, which is shocking. Almost November itself saw Indigo cancel 1,200 plus flights, out of which 755 were directly related to the new FDTL norms, which basically mandate pilots to not do more than 2 night landings, which stood at 6 before this. And among other things, 48 hours of mandatory rest. So all of this has piled up into a big disruption where we've seen, as I said, 130 plus flights cancelled yesterday. And because of this, there is chaos at the airport, there are waiting lines, and some of the passengers have been tweeting that there is no facility, there is no water for the passenger. The kids stranded on the airport. In Delhi, we got to know that there was an issue with the baggage belt as well. Of course, this is like a pile-on effect of what happened with 130 flights cancelled, and we are expecting that these cancellations will go on even today, because Indigo has said that it will take 48 hours at least to
normalize operations. No, absolutely. Thanks very much, Shivani, for that. That's a sort of state of affairs right now, and we'll get you updates. It's an important story for anyone who's looking to take a flight and travel. Well, Petronet LNG is the next one we want to focus on. Sonal has got details on this one. Sonal, morning.
Good morning, Prashant. Petronet LNG and ONGC, they have executed an agreement. This is for ethane unloading, handling and services. This is a binding term sheet for 15 years. And Petronet LNG says they expect to get a gross revenue of around 5,000 crore rupees over 15 years. Nomura says that assuming a conservative EBITDA margin of 60%, that also is a conservative number. They estimate in the first year, Petronet LNG can do EBITDA of 140 crore rupees, while 15th year EBITDA could reach 275 crore rupees. This is without taking into consideration any margin improvement. So good move. They have a buy rating on the stock with a target price of 360 rupees a share.
Okay, all right. Thanks a lot for that, Sonal. Well, let's focus on a couple of other names then from my sector. We're looking at Godavari Power and Ispat, and you had an exchange notification that came out yesterday that the company has received the consent to operate additional 2 million tons of iron ore pellet plant from the Chhattisgarh Environment Conservation Board. Now, the pellet manufacturing facility itself, their capacity for the company on the whole moves from around 2.7 million tons to 4.7 million tons. Bulk of the benefit will be seen in FY27. So the management had guided for this, and that's come about, going with green on that one. JK Cement, they have commissioned their 3.3 million ton clinker line, the second unit out there, and the Panna plant clinker capacity moves up from around 3.3 million tons to around 6.6 million tons. And for the company, the total capacity moves to around 17.5 million tons. On expected lines, management had guided green on both Godavari Power and Ispat and JK Cement. Well, let's get in Upasana. Upasana, morning. Tell us about some stocks and news.
Good morning, Nigel. First up, let me start with IEX on the back of its November update. November volumes have seen an uptick, but the prices remain lower on Y-on-Y basis. Now, total electricity traded volume saw an uptick of 17.7% on a Y-on-Y basis, and day-ahead market volume stood up just about 0.3% on a Y-on-Y basis. Now, coming to the prices, the market clearing price in the day-ahead market stood at 3.07 per unit with a decline of 6.9% on a Y-on-Y basis. Now, company says that the enhanced hydro, wind and solar generation resulted in a higher supply liquidity on the exchange platform, leading to a decline in prices. Next up is RailTel Corporation. The company has received work order from MMR region, that is Mumbai Metropolitan Region Development Authority, for a project amounting to nearly about 49 crores. Next up is RVNL on our radar. The company receives LOA for worth rupees 145 crore from Southern Railway. This is mainly for design, supply, testing and commissioning of traction substations. Next up is Pine Labs on the back of its Q2 numbers. Optically, the number looked positive. Decent momentum seen in the quarterly result, but no big profitability gain as such. Now, revenue has seen an uptick of 18% on a Y-on-Y basis, and sequentially 5.5% growth is what we are seeing. PAT stood at 6 crores versus 5 crores sequentially. So all in all, we are looking out for all these stocks in today's trading session.
Okay, all right, Upasana, thanks very much. Got that. So let's quickly actually recap our list of top stocks to watch today. The ones that have positive news flow would be JSW Steel, Biocon, Petronet LNG, JK Cement, Godavari Power, IEX, RailTel Corp, RVNL and Pine Labs. Interglobe Aviation is the only stock on our radar this morning that has, of course, a lot of negative sentiment and news flow around it. With that, let's move on. Talk about commodities and see what cues we are picking up from there. Manisha is joining in. Manisha, today morning, even I checked silver because you told us that it's been shining so bright last couple of days. Saw some gains again.
Oh, it has. And, another 2% of gains and an all-time high yet again. So we are almost at $59 an ounce, not too far away from that psychological 60. And let me remind you that we started this year with $29. So we've almost and more doubled here. For the Indian markets, the gains have been much higher because of the rupee depreciation as well. And with the way the markets are working with a 90% probability of a Fed rate cut in December, and then very strong ETF and physical investment demand that we have seen come in for silver clearly has been supportive. Actually, there's a premium on silver, not just in India, but various other countries as well, which are holding silver at current levels, expecting that the silver prices can go much higher from here as well. But then it's not just about silver. Take a look at copper, and we're trading at an all-time highs on LME for copper as well. There are warnings of lower global inventories. A large quantity of copper is being shipped to U.S. in anticipation of tariffs. Then the green energy demand expectations also seem to be supporting copper prices. So very, very strong gains coming in for this one as well. And overnight, we've seen the crude oil prices also gain because the Ukraine attacks on Russian energy assets have increased. U.S. and Russia have not reached a compromise on a possible peace deal with Ukraine, and that has added premium to prices.
Okay. All right, Manisha, got it. Thanks very much for a quick roundup. We'll take a break on that note, come back on the other side, and we'll have Dipan Mehta joining in, and we'll discuss some fundamental stock ideas with him. Welcome back. Now, just taking a step away from the stock market action into all that's been happening at Indian airports all through yesterday, in fact, the day before as well, with huge flight cancellations reported. And these are the scenes that you've seen across airports. And if you look at social media feeds, they're completely littered with passengers sharing a lot of anguish, huge delays, 2, 3, 4 hours, flight cancellations. That's what we have seen. And Indigo has seen the maximum impact with over 150 flights cancelled, leaving thousands of travelers completely stranded. Now, what has gone wrong? Is it due to the new norms, the FDTL norms, which basically limit the number of working hours, give the crew and pilots more rest? Is it that? Is it something else? Is it a technical failure? And what's the way forward? I mean, whether it has an implication for the Indigo stock or not, we'll see that at 9 o'clock when the pre-open opens. But right now, let's just understand what's happening on ground. Devesh Agarwal, chief analyst at BangaloreAviation.com, is with us. Mr. Agarwal, thanks so much for this quick conversation. I saw that letter from the Pilots Association, and they also issued their statement. Pilots are saying that airlines were not prepared. These norms were always coming. They were going to be implemented in a phased manner. The airline seems to be saying that it's maybe some, runway or ATC or technical issue. What's really happening on ground?
Hi, good morning. Firstly, thank you for having me on your show. The Chinese have a curse. They say, may you die of 1,000 cuts. So what you're seeing is essentially things that have been happening for about a week now, in the sense that there was issues with weather down in Colombo and in Chennai. Then you had this Airbus A320 software issue come up. You have failure of a baggage belt in Delhi. You have some issue going on in Bangalore. You have some issue going on in Hyderabad. And these are all in and of itself very minor. But on top of this whole thing, as you very rightly said, it was the new norms. And it was partly driven by the AI 171 crash, where the world's focus suddenly turned on India.
Yeah.
And up till now, the DGCA kind of listened to the airlines. And if you see, the issue is not just limited to Indigo. Even Air India a few days back said, we had a technical issue with a third-party provider of services. Who that third party was. So, I'm told that even in Indigo, there was an issue with a major software company. They are facing their own issues. I think Microsoft Azure services went down. So it's all these very small things. But the coup de grace, so to speak, is this FDTL issue, which airlines all these years have been, along with DGCA, they've been managing to postpone it. And things came to a head. Yeah. And this year they expected that, again, they will get an extension. And when the DGCA give them an extension, things have gone a bit haywire.
Yeah, absolutely. And that's what I think that letter, the pilots union letter, also seems to be indicating, almost alleging that at some level, this is airlines trying to arm twist the DGCA back. saying that, we simply cannot meet the new norm, so give us another extension. Perhaps that's one piece of the story. So, my limited question now, because we're running into market open and Interglobe Aviation is a listed stock. In your assessment, could this have any far-reaching consequences if the DGCA does not allow an extension? I don't know how quickly they can get more pilots. Is there a pilot shortage at Indigo? And could it have real implications for the airline's day-to-day operations?
Okay, so what you're already beginning to see is Indigo saying, I'm going to cut back my operation by about 10%. So in a way, it's a tacit admission. See, also another thing, please appreciate, is the way the Indigo network is constructed, unlike other airlines. Indigo operates a lot of what they call point-to-point. And what they'll do is they'll do something like, say, Bhubaneswar to Guwahati. Other airlines will say, I'll take you from Bhubaneswar to Kolkata and then from Kolkata to Guwahati. So what's happening and I'm very sure a lot of the viewers will see, many times they will see Indigo crew deadheading. That means they sit as a passenger on one particular flight. I recently went to Bhubaneswar. The crew that was supposed to operate the Bhubaneswar back to Bangalore flight was flying to Bhubaneswar as a passenger. Now, Indigo is going to have to restructure their network. They are going to ask DGCA. They're going to do everything that they will to, optimize the whole situation. Having said that, Indigo, in my opinion, is a very professionally run organization. And so I expect them within 48 hours, at least they have been bold enough to say, yes, we are cutting back capacity in order to, kind of reset the whole situation. I don't see too many Indian corporations being willing to do that and say, I'm willing to cut back on capacity. So that's speaking positive. Indigo stock will definitely take a hit in the short term. And I must give a disclosure. I'm an Indigo shareholder myself. But I definitely feel that there will be a hit in the short term, but on the long-term basis, I think it's shall we say, par for the course. The airline is very professionally run, and they will come.
Sir, just a quick, small question here. The allotment of slots. Now, that is an ongoing thing, and slots are allotted not for 1 or 2 days, right? Now, if Indigo's capacity cut continues, it's 10% now, then we run into the winter schedule. Is there any risk of Indigo being asked to give up some slots?
The winter schedule already began. It always begins on the last Sunday in October. So, if anything, Indigo is assured of its slots during this winter season. And it needs to operate the slots even, there's a minimum set of operations. If you notice, another airline based out of Delhi, I don't want to name them, but they've been repeatedly failing on meeting their slot assignments. And still they, somehow operate just the right number of flights to retain those slots. Okay. I don't see that happening at Indigo. What I see is, what will happen is you will see the passenger load factors of Indigo increasing because their number of flights will reduce.
Has reduced.
So the same number of passengers are going to travel on that airline, albeit on a fewer number of flights.
No, absolutely.
You may have a few passengers shifting to other airlines,
but
Indigo still has the best reputation in terms of on time and
we'll leave it there. We'll leave it there. Thanks very much for joining us. Good speaking with you, and appreciate you coming on. We can continue this discussion. Sorry, apologies. We're running at a market open. 15 minutes away is where the market open is at. We'll come back. Dipin Mehta, Director, Elixir Equities, is joining us in just a bit.
Welcome back. Hope you're having a good morning. As promised, we have Dipan Mehta, Director Elixir Equities, who joins in on the show. Hi, Dipan. Good morning. Good to see you in, and glad to see you're not taking a flight. Going by what the visuals that are coming in there. Let's address that stock first. Interglobe Aviation, been the leader, gained market share. If I look at the last 1 year, I think from 62% to 65%. I'm going by a Jeffries note. But now there's a near-term headwind that's taking place. What do you do with the stock? It's not cheap, but it's the leader.
Yeah, good morning, and thank you for having me on your show. Yes, thankfully, I think that tough times for people taking flights and planning their holidays or whatever, and really reach out to them. because I know what it is for a flight to get cancelled. But look, first of all, as a disclosure, we're investors in Interglobe Aviation, our clients as well, in a model portfolio as well. And I think this is a temporary blip. And if investors do not have shares of Indigo, this is a good opportunity to get into the stock if there's a steeper correction. It's trading about 10% below its all-time high. Another 10% correction would give some amount of margin of safety, and they'll work around these problems. And eventually, I think it's a nice, steady, secular, fundamentally strong, growing company, and industry also dynamics are very good, structurally low cost as well. So very positive on the long-term prospects. And such temporary negative news flow are great opportunities to increase exposure.
Deepan, the morning markets gone dead, literally, right? I mean, sideways, lack of any enthusiasm. Of course, I mean, there are single stocks here and there, but broadly, broader markets especially are hurting. What do you make of it?
Good morning, Prashant. I have no complaints. I think this quiet period, this mild correction is a great time for investors sitting on the fence and investors sitting in cash, looking at increasing their exposure. This is the perfect time to, look at.
Deepan, but majority are already in it. Who's sitting on cash? Nobody. At least we speak to, fully invested. So, I mean, if you created cash, great. But yeah, sorry, go on.
No, but Prashant, you could always look at some of the slower growing large cap stocks, exit out of them and get into a lot of the mid cap, small cap stocks. I know that the mid cap, small cap index has been underperforming, but that can't last for long. And you have a lot of large cap stocks, where growth rates are kind of fizzling out. And you could do that transition and increase exposure to small mid cap stocks because once the earnings start to move up over there, there's no going back over there. And also, I think that, intuitively, I do feel that investors can always allocate more from other savings into equities. But these times, these quiet periods, these mild corrections are great. And it forms the foundation for the sensex, nifty, and the mid-cap indices to start the next journey on this multi-year bull market. So just, I think, some positive triggers required, and we'll be out of this kind of stagnating phase.
This is so refreshing, Deepan. I think you're the most optimistic and positive voice I've heard at least this week. I can officially endorse that. It's good, right? It's good to keep that perspective intact. Now give us some names. If someone wants to get out of dud stocks and look at something more interesting in mid caps, give us some ideas.
So we are doing a lot of bottom-up, research, and typically, again, when we talk about names, have to keep on giving disclosures that we may or may not have, may be invested in these stocks. So let's look at travel. Okay, now we give this idea about Indigo. I think if it corrects, the other 5-10% is a great opportunity. But within the travel space, there are companies which are having quite different business models. Like we're very positive on Yatra Online, which is like a online travel agency. And then there is BLS International, which does visa processing. Then another sector we are positive on is insurance. And over there, you got companies like MediAssist and Sagility, which of course, Sagility does claims processing for US customers, and MediAssist is for Indian customers. And there's of course Policy Bazaar, which is one of the largest insurance agents. And I think it's a great platform company about to go solid into profit in the next 2-3 years or so. And like that, down the line, I think there are a lot of stocks which have a slightly differentiated business model. In the fintech space, we like Zaggle Prepaid, also exceptionally good numbers over there. So like that, I think companies which have got a slightly different business model and one of the kind, I think those should certainly be considered. In the CapEx space, I think all these solar equipment manufacturing companies, they are having great dynamics, right from Vari to a whole host of new listings. And then there is also the wind turbine manufacturers, both Suzlon and Inox Wind, which we are positive on.
Deepan, since you mentioned fintech and you singled out Zaggle, I just wonder if you've had a look at Pine Labs. They came out with their numbers also yesterday. What do you think?
Well, I think that, it's still a company which is yet to come into solid profitability, but it's a great compounding story. And the way I look at these companies is that what happens if these companies double their turnover in 3 or 4 years, which is what it seems to be happening over there. And their costs remain steady, and you could have these companies going into solid profitability. So basically, it's a tech company, and it's got a great, I think, competitive edge as well. And it's got a potential to grow overseas as well. So it's on our watch list. And I think, a quarter or two will come when you know that now, okay, this is poised to take off and go into solid profitability. That may be a good entry point. So I always keep a watch on these companies, maybe not investing in them right now, but trying to see if the business model is evolving into a phase where they'll now go into solid profitability.
Deepan, stay with us. Just a quick look at the movers from yesterday, the big movers and the heavy volumes. Hormuz is here with that. Hormuz, take it away.
Morning, Prashant. Start off with Hikal, and the biggest single-day gain since April that the stock saw yesterday, and volumes were the highest on record for the stock in yesterday's trading session, and yesterday's volumes were also the sum total of almost 140 sessions put together previously. For almost 4.5 crore shares traded yesterday. The 20-day average is just under 2 lakh shares, but only 4% of those 4.5 crore shares are marked for delivery. There's close to 20 lakh shares marked for delivery, 20-day average of 92,000, and the stock is now rebounding from its 52-week lows, but still 45% below those levels. GHCL saw its 5th straight day of gains yesterday. The volumes were the highest since January. 12 lakh shares were traded yesterday, the 20-day average being 2 lakh shares. Out of those 12 lakh shares, 4 lakh shares are marked for delivery, the 20-day average being just around 1.5 lakh, and this too is down around about 20% from its 52-week high levels. And lastly, Indian Bank among the top losers within the PSU banking space yesterday. There's multiple factors contributing to this fall. They're down almost 8.5-9% now in the last 2 sessions, and declines on volumes that were the highest in the last 6 months. Close to 71 lakh shares traded, the 20-day average of around 15 lakh shares, and around 30 lakh shares marked for delivery, the 20-day average of just around 8 lakh shares. And the stock as recently as the 18th of November had hit a record high and was up almost 10x over the last 5 years.
Okay, all right. Thanks very much for that, Hormuz. Appreciate it. Deepan, shorter chat today. Had a bunch of other questions, but I guess we'll pick it up on some of these later. Appreciate you joining us here this morning as well. We'll take a break. We're back. That big steel deal is in focus. Vikash Singh of ICICI Securities on it on the other side. Welcome back. There's a minute to go for the pre-open session to kick off, and Sudarshan Sukhani is with us, so is Mitesh Thakkar. Gentlemen, good morning. Great to have both of you here. Thanks very much for joining us. Mitesh, you go first. How are things looking? Gift Nifty is indicating another 60-65 odd point lower start. If you get that, what do you do?
Good morning, Prashant. So I think, what will most likely happen is that the kind of intraday gains which you made might be given up today in the morning. But the overall idea is that the market is still not showing signs of any decisive breakout on the upside, and on the downside, it's, last 3 days has seen the markets kind of come closer to support areas. I've said that 25,800, 850 is the broadly lower end of the range, and 26,300 is the upper end. So I believe that this range consolidation might continue unless until we see a break below 25,800. I think then, we'll look at some more correction.
Okay. Got that. Sudarshan, good morning. What would you say? What's your perspective?
Yeah, good morning. See, once the Nifty crossed and came below 26,100, that was a significant support level which was broken. So for me, the Nifty is now in a no trade zone. It's very difficult to say this is where it will stop or this is where it will go up. The market will have to give a clear pattern, and that will take some time, at least not today. So the Nifty is a complete avoid, and that goes for the Bank Nifty also.
The other, got that, no trade zone right now, at least in the Nifty. The rupee, the rupee market is open. I think we made a new low, and that's the other problem. With 90.41 is the new 41. That's a new low against the US dollar, and I think it's pulled back a little bit, but it's going, right? I mean, every day you open with about 0.25%, weakness against the dollar, and then it gets pushed back during the course of the day. But that constant pressure is there, which is, something to take note of. Let's wrap up the trades with both Sudarshan and Mitesh. Sudarshan, what would you do? Any trades stock-wise?
Yeah, it is. The trades are confusing by themselves, too long and too short. That tells me that I don't understand the market today. TCS is a buy with a stop under 3120. CYIENT is a buy with a stop under 1160. Blue Star Company is a intraday short with a stop above 1785, and PNB Housing is an intraday short above 905. But it's best to keep volumes low.
Yeah, position size low. Mitesh, what about you? Stock by trades?
I also have a mix of buys and sells, slightly more on the buy side. CDSL, though, of course, the first call is on the sell side. CDSL with a stop at 1566.67. Sell for targets of 1520. And on the buying side is Memphis with a stop at 28.34 for targets of 29.20. Hindustan Zinc, I think, comes back on the buy side radar. That's a buy with a stop at 498 for targets of 5 and 6. And also a buy on ICICI Bank on a minor dips around 1385. Buy with a stop at 1372 for targets of 1410.
Okay, all right. Got that, gentlemen. Thanks very much. By the way, the pre-open session is opened. The first rates on Indigo were all over the place. I mean, in the first take in the pre-open, Indigo was down 10%. Now it's settled to an extent. It's down about 3.5–4% right now. So the market is taking note of these disruptions. The clear issue is whether these are very, very temporary in nature, a 1–2 day affair, or whether they have a longer lasting impact on Interglobe Aviation's operations. So that's a stock in news. The other one in news, of course, is going to be JSW Steel. So Nigel, just once again explain to us how this helps the listed entity, JSW Steel, the ultimate deal.
Well, that's right. JSW Steel and JFE, that deal has been announced, right? JFE will invest a total amount of around 15,700 crores in 2 tranches for 50% stake. Now, JSW Steel could see some green and could bounce back after a bit of a disappointment yesterday. Why is that? The management says the enterprise value is 53,000 crores. This is as good as what the street sniffed. Let me break this down for you. JSW Steel initially gets close to 24,000 crores for transferring the asset out of their books. Add to that, there is a 5,000 crores of debt that's already sitting in BPSL. So the total number that we come out to is around 29,000 crores because 5,000 crores is getting deconsolidated from JSW Steel's books and you have 24,000 crores. Now add to this another 7,000 crores, which is the second installment from JFE. So 29,000 crores plus another 7,000 crores, approximately 37,000 crores is what you are at. But you need to keep in mind that JSW Steel continues to own that 50% equity, which is valued at another 16,000 crores. So the value is, that 37,000 crores, you add another 16,000 crores, which brings you to around 53,000 crores. What changes for JSW Steel? Net debt reduces by more than 45%. The EBITDA hit, or the EBITDA that goes out of their books, is around 11% approximately. Brokerages, they are enthused. Nuvama says the deal is likely to enhance JSW Steel's fair value by 37 rupees. Motilal Oswal says the development will support JSW Steel's deleveraging plan. Net debt to EBITDA comes down from around 3 to around 1.7 odd. And CLSA, they have an underperform rating, but they estimate that this will lead to a sharp reduction in JSW's leverage, and the value creation will be to the tune of around 30 to around 70 rupees. While Jefferies, they have a buy rating. They're saying that the JV with JFE is broadly neutral for EPS estimates as well as for fair value. So put everything together, this deal is not as weak as what the street thought of yesterday, and 50,000 crores is as good as the sniff that we saw. For the starters, the stock is still a little bit in the red. There was a lot of pre-buying. Keep that in mind. Open interest as well had moved up drastically, but the deal is actually pretty okay. To discuss this and more, we're joined by Vikas Singh, VP at ICICI Securities. Vikas, we would have preferred if the deal was straightforward, right? 53,000 crores, if it came in the press release, there would be no confusion. But I was at JSW Steel's office yesterday for an interview, and I believe you all had a face-to-face meeting as well. Now you're satisfied with this deal?
Hi, Nigel. Good morning. Yeah, so the deal is actually tailor-made for JSW Steel to cut down their debt by almost half.
Yeah.
And this would also give JSW Steel an opportunity basically to expedite their other projects like Dolvi and Odisha projects, basically. So yes, overall, the deal is favorable for JSW, but overall impact, we don't see it to be very high. The only thing it does is help JSW with their debt levels.
Okay, all right. So it's favorable for them. Just a quick question. BPSL now, the total, that entity itself moves out of the books. The EBITDA hit will be to the tune of what? 11–12% approximately? Capacity as well as EBITDA hit?
So as per the last year's annual number, the EBITDA contribution was 10% in the overall consolidated level, and from capacity point of view, it's for closer to 14–15%.
14–15%. Got it. BPSL, but they have ambitions to increase their, the total the total capacity from around 5 million tons to 10 million tons. But the debt in the books is going to be large now, 21,000 crores. You see it as a challenge, or do you believe the cash flows that they're generating will be good enough? Plus, you'll get some funding coming in from JFE. Is that the way you're working with?
So that 21,000 plus crore of debt is actually divided into two parts. The BPSL operating debt would be somewhere around 12,000 crore, and the holding company, which is the JV of JSW and JFE, would have another 9,000 crore of debt. So up to that 12,000 crore at current steel prices, I still feel that the servicing of that 12,000 crore would not be a big challenge. The doubt is still on the 9,000 crore of the holdco company debt, which would be there. So because see, that money has to be serviced after paying taxes from the PAT and dividends. So currently at current steel prices, we have a slight doubt that they would be able to meet that or not. And any future capex, obviously, both the partners have to pitch in some money for the future capex, because current cash flow doesn't support 5 million ton of expansion at this point of time with 21,000 crore of debt.
Correct. What about JFE? The last investment made them good money. They put 4,800 crores 15 years ago. Today it's 42,000 crores. From their perspective, what are they betting on?
I think they are betting on the Indian market, basically. If you look at the demand, India, from a large steel demand perspective, India is one of the fastest growing steel market. And their home, basically Japan, they are not getting any growth, actually it's degrowing. So effectively, I think they are betting on the high growth market of India, because even if at 7 to 8% steel demand, the cumulative demand over the next 4-5 years could be 40-45 million tons minimum. So they're betting on a high growth market, and that's why they probably would have gone for this kind of investment at a slightly higher premium.
Okay, all right. Final question before we let you go. Have you tweaked your estimates? You're sounding optimistic on the deal. EBITDA hit is around 10%. I think capacity that goes off their books as well is roughly around 12-13% approximately. But debt reduction is drastic. So have you ascribed a value that aids this, since it's accretive to the company? Have you put a value to it?
No, we have not changed our estimates because deal is not done yet at this point of time. But on a net basis, basically, this could be 3-4% positive on the overall target price of ours. But at this point of time, we are maintaining our hold rating with the same target price of 1110.
1110 is what you have. All right, Vikas, thanks a lot for joining in and running us through that analysis. Deal a little bit complex, but post the management explanation, that deal is actually lucrative and explains why the stock yesterday recovered from the day's low, and today it's up close to around 1.5% or thereabouts.
That is.
If any questions should be, I can answer.
No, I think now it's been covered very, very comprehensively, and we understand that this is indeed not as negative. That was the market's first reaction yesterday, but now with more details, it seems to be coming up. By the way, the pre-open session is settled completely. The Nifty is absolutely flat. And so is the Nifty, the mid-cap index as well. I mean, absolute flat cues coming through. On Interglobe, let's just watch this. It all boils down to whether the DGCA is going to ensure that this time these new norms, the FDTL norms, which affects crew rostering, how many pilots can you fly, night landings, etc., whether they're pushed back again or if they need to be implemented. So that's something we'll watch out for. Let's quickly get to the 9-10 calls with our technical experts. Sudarshan, which stock will it be?
It'll be TCS. Buy TCS with a stop under 31.20.
And Mitesh, for you?
Hindustan Zinc on the buying side for targets of 5 and 6.
Okay, all right. Thanks very much, both of you. Sudarshan is now standing by with the top brokerage calls of the day. Sudarshan, over to you.
So HSBC has initiated coverage on Tata Consumer with a buy call and target here is 1340 per share. It says company has scope to expand and deepen distribution to drive growth, and HSBC forecasts 26% over FY25-28 CAGR for the growth portfolio, and growth portfolio's contribution to India revenue should rise to 37% by FY28 versus 28% that company recorded in FY25. It believes that aggressive acquisitions and distribution for the company should pay off going forward. Next one is Motilal Oswal has written on Aurobindo Pharma. It maintains buy call and target is 1430. It says broad-based growth momentum has been building up. Domestic Pen G manufacturing position for a healthy growth, and expect company to deliver CAGR of 9% for revenue, 14% for EBITDA, and 21% for profit over FY26-28.
All right. Interesting calls there. Thanks very much. For that, we'll keep an eye out on those stocks. The oil and gas space is the other area we want to focus on. And Sonal is here with this one. Sonal, over to you.
Well, you know, a lot of changes in the macros for oil and gas space. Let's start with gas prices, because Henry Hub prices, which is one of the sources of import of gas for these oil and gas companies, those prices are up 47% since end of September, and this will impact MGL and IGL margins because they do have a lot of imports coming in from this gas source. For MGL, it's more than 30% gas coming in from there, and for IGL, it's around 18% of gas coming in from there, so their input costs would go higher, impacting their margins, and that is the reason these stocks will be in focus. For GAIL as well, 80% of their US gas contracts of around 5.8 million tons per annum comes from Henry Hub gas. 20% is on spot LNG prices or back-to-back basis. So they will not be able to earn that spread on that 20% mark. And that's the reason GAIL could be negatively impacted because of this, but not such a big negative as well. The other part is that Saudi LPG prices, they are up 3 to 5%. For Gujarat gas, it will be a positive because propane prices, which is a competitive fuel, that is based on Saudi prices. So if propane prices go up, maybe consumers will look at Gujarat gas for procurement. That's why Gujarat gas is in focus. For oil marketing companies, it would mean that LPG under recovery could increase to 45 rupees per cylinder versus 17 rupees per cylinder. That could be a negative for oil marketing companies. The third fact has been that diesel and petrol cracks, they've been coming down. We have spoken about it in detail as well. Diesel spreads are down 19% on a week-on-week basis. Petrol spreads are down 1% on a week-on-week basis. Still, Nomura is positive on these companies because refining margins are still above historical averages, and they expect refining to do better than marketing. But this could be a near-term dampener for oil marketing companies. And rupee depreciation, that continues to remain the big story. City gas distribution companies, big imports coming in, and that could be negative for them.
Okay, all right. Thanks very much, Sonal, for that. So lots of affected companies, and we'll keep an eye out on those stocks as we open up for trade. So JSW Steel, Biocon, Petronet LNG, some of the names which will open up with regards to news flow. JK Cement was the other one. Godavari Power, IEX is another one. And I mean, off we go with market open. What do we have? 25,968 on the Nifty, absolutely flat. The Nifty Bank is unchanged almost, 59,300 basically, 350 or so. The sensex is unchanged, the small cap index is unchanged, the mid cap index will come up with nothing on it as well. It's 1:1 advances to decline ratio, nothing very much happening there as well. Nifty 50 heat map gives you a quick sense of where we are starting, and then we'll pick it up from there. So what do we have? 40-point cut, 25,946. And you got about, what, 16, 17 names which are starting in the green. JSW is on one end of the spectrum in green. And of course, Indigo is selling off on the other end. Surabhi.
Okay, I was just looking at the stocks that Sonal was mentioning on the back of this Nomura view. Nomura is concerned about the rise in Henry Hub prices. And MGL and IGL source a lot of their gas, based on this. Not too much on the stocks right now. Mahanagar gas is down about just 0.25%. IGL is actually up about 0.5%. So not really showing up in terms of stock price concern, at least right now. Interglobe Aviation, 3% lower on the stock now. So let's see. The biggest issue is that, is this a passing disruption or is it something more structural in nature? And we'll have our answers, I think, in the days ahead. Apart from Interglobe, the other stocks on the downside would be a Power Grid. Titan and HUL from the consumer space are seeing some profit taking. HDFC Life is down about 0.5%. Max Healthcare down about 0.5%. SBI Life also slightly lower. Let's look at the upside of the screen then. JSW Steel, like Nigel was saying, that now that we all know the deal contours, the details, it's not that bad at all. And perhaps helps the listed entity deleverage. So 1% up on JSW Steel. TCS is up about 1%. That was Sudarshan's intraday call for today. 1% up there. Hindalco seeing some traction. HCL Tech and TCS, both actually up and about. So Tech is seeing some buying. And then there's JSW Steel on the upside. Everything else is very flat.
Well, that's right. Our colleague Yash had reported that that deal was in the works, and that deal actually has been announced. And now it appears, slice and dice everything. An EV of 53,000 crores. It's more favorable actually for the company. Explains why JSW Steel is up. What else is doing well? Spark getting back to its winning ways, up close to around 4%. Big move is what we're seeing out there. Petronet LNG, favorable news flow coming in overnight. Maybe in the longer term with that deal that they've done with ONGC. But for the timing, the street is celebrating that. It's up close to around 2.5%. Hikal is up close to around 4%. And the volumes are very, very high on that one. I'm not sure what's going on there. But big move is what we're seeing out there. Godavari Power and Ispat. Favorable news coming in there. Capacity going from around 2.7 million tons to around 4.7 million tons. Stock marginally up close to around 1.5% or thereabouts. What's coming for profit taking? Grow is actually coming for profit taking. Stock is down close to around 4%. So that one actually the volumes are quite high for the first few minutes. Ola Electric is another one. Remember, it went dancing away from around 35-40 rupees all the way to around 70 rupees. It's back at around 37 rupees. So that actually is coming for profit taking. Biocon, I think there was some news flow that came in overnight. That one as well is down close to 2%. Volumes quite large. Net, markets down marginally. Mid-cap index trading in the green. But the Nifty Bank, that's down 100 points. The rupee, though, can't get your eye off that. 90.4 on the rupee.
Well, it's holding around the lows, right? I mean, there's no big push. And over the last 2-3 days, what we've seen is there is some, I'm assuming the RBI steps in, provides dollars at some point during the day. And it pushes it back. But for now, 41 was the low and we're at about 38, so not very far away. Ashwini Agarwal is with us, founder and partner, Decemeber Advisors. Ashwini, good to have you with us here. Thanks very much for joining us. For viewers who are watching at what's going on with the currency and with the equity market being slightly sideways and a lot of damage in broader markets, how should they take the rupee depreciation, which is kind of the new dynamic? It was holding above 88.80 2 weeks ago, and now, of course, it's raced away to almost 91.5, 90.5. What's your perspective?
Morning, Prashant. I'm not an FX expert, but I'll give it a shot. So essentially, what's going on in my view is the capitulation that typically happens, whenever we've seen a sharp correction in the INR versus the US dollar. Whether it was 2013 or it was previous bouts of significant devaluation, you see a situation where everybody panics, the importers panic, there's speculation that goes on, and it pushes the rupee to an unsustainably low level, and then it kind of climbs its way back. So this time around, what's happening is that the deal with the US on tariffs, which was expected for several weeks now I think the hopes have faded somewhat. People hope that the deal will happen, but I think the confidence around that has waned a little bit. And I think also the interest rate dynamics are feeding into the exchange rate, in the sense that there is a general expectation that RBI will cut tomorrow by 25 basis points. And even though the US dollar or the US markets are expecting a 25 basis point cut in the US as well, I think the lower interest rate is hurting the rupee outlook. And last but not the least, foreign selling continues unabated. And that, I think, has to do with the fact that Indian growth in earnings has been quite tepid, and foreign investors are probably raising cash from secondary markets to participate in primary markets where the paper flow continues to be high. So there are a lot of kind of intermingled dynamics here. I'm not sure, what RBI wants to see as a stable level before they participate. And I don't know what they feel about the reserve situation and how much they want to spend to defend the rupee. And these are hard calls. I think, I'll just leave it at that. I think for equity market investors, what it really means is that anybody that's long dollars in the revenue stream with no significant costs in other currencies, And I make that as a point because the dollar has been depreciating versus other currencies. So if you're an importer from China exporting to the US, you're squeezed on both sides. You're squeezed on the cost side as well. So some of the net dollar receivers on the revenue side is probably going to have a sentimental tailwind, which is why what we are seeing in IT services right now. So that's about it, I guess.
Okay. All right. That's on the dollar rupee. Hi, Ashwini. Great to have you in. So I wanted to discuss pharma because some interesting developments taking place here last couple of days. Wockhardt, announced further regulatory approvals for its antibiotic drug that could be well over $1 billion. That's what the company feels in global sales, Zynic. And look at Sun Pharma. Sun Pharma Advanced Research is up almost 20% because, again, there's a favorable US court ruling that gets them what is known as this PRV, which is basically an incentive for developing, less attractive drugs. So it's an incentive. You can either use it yourself or you can actually sell it in the market. Something like the TDR that we have here in Mumbai in real estate. So anyway, I mean, there's a slight favorable news flow coming in. Biocon is now looking to attract some capital, perhaps. We're in a defensive sort of a mindset in the market as well. So does pharma make the cut for you? And if yes, and what kind of companies?
So great question. I think, what has happened is that some companies in the last 10, 15 years have spent a fair amount of money on novel drug discovery. Sun Pharma, for example, has done a little bit of novel drug discovery via Spark. But they've also done a lot of buy and process type of deals to build up their specialty portfolio in the US. The other name that comes to mind is Glenmark, that has had a significant success in out-licensing a novel drug. And then you spoke about Wockhardt Zynic, where the application has been accepted by the US FDA. I don't think it's an approval, it's an acceptance, and the approval hopefully will follow in due course of time. Now, what this indicates is that the Indian ecosystem in pharma is now getting to a point where companies are willing to put serious money behind drug development and drug invention and drug development, which I think is a very, very positive sign. And you have 3 companies now having demonstrated some success. And that, I think, is a huge positive in my view. So from the export side, I think I continue to be positive on some of these names where you have a differentiated portfolio or a differentiated go-to-market. And then in the Indian space, again, you have to look at differentiated companies to benefit from this defensive stance. Now, let me explain what I'm saying. In the local market, what I see happening over the next decade is a significant shift towards generic. And to my mind, that is an opportunity as well as a threat, because the kind of premium some of the brands get today may come down significantly, or at least the share of branded pharmaceuticals being sold in the overall pie might shrink. So, I mean, in the Indian landscape or in companies where the domestic revenues are concerned, you will see a shift from the premium unbranded generics to more generics, and that's something that you have to bake in. So it's a bit tricky, but you can do it. So there are select opportunities out there in pharma, and as a defensive play, I agree with you that that's a place to hunt.
All right. Hi, Ashwini. Morning. Good to see you in. What are you making of the real estate market? On a health front, a lot of calls with regard to pollution. Oof, what's going on there? Hopefully that settles down. But I think you have been positive on REITs, if I remember correctly. And you had said that that's the better way to play it.
Yes.
Real estate stocks have seen a big correction from the top. Do you still stick to that REITs, or do you think now post this correction, maybe you could look at the core real estate stocks itself?
So, Nigel, great question, because, REITs appear now to me as reasonably valued. They were very undervalued 2 years ago, and they were relatively undervalued even 6-8 months ago. But now they are no longer undervalued. And they're a play on commercial yield more than a real estate itself. So, you're really buying into leased office space and taking those cash streams and viewing it like a hybrid, a growth come yield product. So, for a risk-averse investor trying to build income streams, that is a very good alternative with potential for appreciation, because most of these REITs were trading at discount to NAV. Today, that's not the case. But real estate stocks have come off, like you rightly point out, and that makes things interesting. The market has consolidated thanks to RERA and thanks to the stringency that both regulators and investors and banks have brought to lending practices in this space. So most of the big players will be survivors. Having said this, I think the only thing that bothers me is that most of the development is happening in the super premium luxury space. I mean, that's what's dominating the headlines, and I'm kind of a little gobsmacked as to how many people can afford to buy 100 crore homes. I mean, so that kind of leaves me scratching my head as to what's happening to the mainstream real estate market. And typically what we've seen is that in economic slowdown and if markets don't do well, real estate tends to follow. I'm not sure whether this is the case this time or not, because typically real estate cycles are 7-8 year cycles, and this bull cycle began in 2001, 2002. So we are relatively early in the cycle. But I think I pointed out kind of some of the advantages and disadvantages, and with the price correction, there might be opportunities out there. So that might be a place to hunt as well.
I just want to, so Surbhi, just to come in, I don't know, the 100 crore homes, I'm very satisfied in the home that I'm currently living in. And going by the rupee, next year's overseas trip as well is cancelled. It has to be domestic.
On affordable homes, Ashwini, I'll tell you this, maybe I'll forward you that report. Since you mentioned you don't know who's buying these houses. Yesterday, one of the real estate consultants came out with a press release and a report. And I saw the title and I think I somersaulted in my chair. This was Collier's saying most tier 1 cities see notable improvement in average affordability levels since 2010. So yeah, I did a somersault in my head. I'm still trying to go through the report and I'll share it with you. And we'll see if it convinces us that indeed housing has become more affordable. But
just off the thing, right? Why 2010? Obviously, it'll be better than 2010, right? You should look at it over the last 4 years, 5 years.
See,
why is 20? I mean,
so
50.
apparently we can afford houses.
So you're basically saying that the average pay is up a little bit compared to 2010?
I couldn't go beyond the title and the first 2 lines of the summary. I mean, I just kept staring at it. So I'll tell you when I read the whole report if it makes sense.
I think Ashwini is saying something. Ashwini?
That would be true. Like from 2010 to today, appreciation in real estate is probably much lower than nominal GDP growth rate. So arithmetically, that would be true. Affordability is better
what,
today. Yeah.
So since we're on the subject, I have the report open. Average affordability measured by the average housing price to income ratio. That ratio has improved from 88.5 to 45.3 in the last 15 years. Ratios are fine. At the end of the day, you go with a check and try and buy an apartment in Delhi or Mumbai. Good luck. I don't know. I have not been successful. So it is what it is. But Ashwini, tell us, I mean, in this sort of a market, I mean, leave us with your overall broad thoughts. Next 6 months, we're entering a new year as well. I mean, do you feel that momentum and that action is going to come back in the broader markets as well? Or do you think we need to just, prepare for more consolidation and then hope for more stock-specific ideas?
So, Surbhi, I'm going to say something which I hope I won't regret. Okay. I don't think I have been able to find a lot of bottom-up opportunities over the last 12 to 15 months. Okay. But in the last 3 months, I'm starting to find a lot of interesting bottom-up opportunities which give me a reasonable IRR in terms of an outlook and not baking in excessive optimism either on valuations or on earnings outlook. So I think the correction in the broader market, especially stock-specific real estate names, for example, you pointed out, offers an opportunity from a medium-term perspective. Now, I have no idea what the market will do in the next 3 months or 6 months or possibly even a year. But if one were to buy some of these names and hold them for a 3-year period, I would venture to think that you'll do reasonably well with a mid-teens kind of a return on a conservative basis. Now, I think there are a lot of ifs and buts because I think, the US looks a little, in an iffy place, especially with all the noise coming around AI investments being ill-affordable. I think in India, we have a challenges cut out, assuming that the US trade deal doesn't materialize. So I think we have to navigate these challenges, but I think medium-term outlook is good. So I feel a little more constructive today than I did a year ago, and that's a thought I want to leave you with.
Relatively sort of more constructive in that sense. Thanks very much for joining us, Ashwini. Really appreciate your time here And good speaking with you, as always. Biocon is what we want to focus on next. Ekta is here with, of course, the announcement yesterday, post-market hours, and what it means for the listed companies. Ekta, take it away.
Well, yes, for Biocon, it is in focus, and the buzz was on from yesterday itself that there could be a board meeting with regards to Biocon on what they could announce when it comes to Biocon Biologics as well as Biocon. Now, the board meeting they've announced to the exchanges will be held on 6th December, which is Saturday. So they will be considering a few things. So first is the investment in Biocon Biologics. That's one of the key things. And that would be by way of purchase or acquisition of securities from shareholders of Biocon Biologics. And secondly, they will also be considering fundraising, which is raising funds via QIP, rights issue, preferential issue. And remember that all of this boils down to the debt that Biocon has on its books. Biocon has around $1.2 billion in terms of debt on its books. And there have been a lot of considerations in terms of what they could look at going forward in terms of the steps for Biocon Biologics. So one of them was constituting a committee to also consider the merger between Biocon and Biocon Biologics. That is something that they spoke about, could be possibly announced even by the end of this year. So we could probably hear on that in tomorrow's board meeting as well. Remember that Biocon has been raising funds continuously. They raised 4,500 crores via QIP just in June 2025. They've been selling stake. They sold worth around 686 crores in terms of stake in December 2024 in Syngene, and in Feb 2023 worth around 2,240 odd crores, and in September of 2022, which is the year that they struck the deal with Viatris on the biologics business, they sold 5.4% stake worth around 1,220 odd crores. So the fundraising continues. Kiran Mazumdar-Shaw has indicated to us multiple times that as a company, they are very committed in terms of reducing that $1.2 billion debt on their books, and hence all these steps are probably in line to do that.
Okay. All right. Got that, Ekta. Thank you very much for giving us the details on Biocon. The stock continues to be in focus. Let's move on to our first management conversation on the show. Then Indian Railway Finance Corporation is in focus after it has returned to the external commercial borrowings market after 5 years. The PSU has raised about 300 million in yen from Sumitomo Mitsui. We have with us Mr. Manoj Kumar Dubey, CMD of IRFC, and we want to focus on three key points. One, of course, is the whole thought behind returning to the ECB market and what it really means for the cost of funds. And we want to understand what the asset diversification can spell for IRFC's margins, because they're looking at many more segments beyond just the railways when it comes to financing now. And finally, we'll get a check on the disbursement guidance for FY26 as well. Mr. Dubey, thank you so much for joining in. So let me take up the first point. You're going back to the ECB market and raising loans in yen. And so this is very interesting at a time when the general expectation is that interest rates in Japan will actually rise, or could actually rise, because of what's happening with inflation in that country. Just tell us how this makes sense for you. What will be the cost of servicing this debt? And what happens to the currency risk? Because, this borrowing is happening at a time when the rupee is, sliding to past 90.
So, morning, Surabhi. There are a few corrections in the beginning. One, that we are re-entering into ECB market only after 3 years, not after 5 years. And two, this loan is for $300 million worth of yen that we signed day before yesterday in Gift City. So, we have a very long relation with the Japanese banks for raising ECB loans. And yes, yen is a bit fluctuating currency. But, once the rates go high in that side, the hedging cost comes down. So we have our own experiences, and we feel that going forward, with the kind of hedging cost optimization, we feel that this is a very, very good opportunity to put yen also in our mix of borrowings.
Okay, so now that you're back in the ECB market, what is the cost of this borrowing, the yen borrowing that you've done? How does it compare with your blended cost of borrowing?
Yeah, so I won't tell you the rates, but as we have come to know that in the year 2025, this is the best ever rate that we have got by anybody who has raised the yen in the market. So that is a reinforcement of the fact that our zero NPA status and the kind of the fact that we are lending to the government entities, not limiting to railways now, still commands a very good respect in the lending market. A. B, to share with you, we are also opening one more bid on 8th of December itself for $400 million worth of dollar yen. So we are a little bullish on this regards for the fact that our disbursement have started now, picking up the pace with more than 50,000 crores of assets already being signed. So we want that in a healthy manner, 25% to 35%, 30% of my borrowings would come from the ECB, and right now we are focusing mainly on yen as one of the foreign currencies.
Sir, but how does that make commercial sense for you? If you could help us understand, because interest rates here in India and the expectation is maybe we'll still get some kind of rate cut. So I'm just trying to understand how borrowing in yen makes commercial sense versus, say, rupee loans here or loans elsewhere.
The AAA bond market here or the bank rates that you are getting here, and of course taking into account for the fact that there may be a repo rate cut also again. For 5 to 10 years tenure, we feel that with the hedging cost, the lending will be around somewhere between 6% to 6.2% from the yen also. So that makes sense for us. We cannot put all eggs in one basket. So we feel that for the longer tenure, with all the things taken in together, this will be a very lucrative and attractive mix in the total basket that we are trying to create.
Oh, okay. So hedging costs and all other costs put together, the cost of borrowing in yen should be around 6.2.
So it should, yes.
Okay, and you said that you want to shift almost 20 to 25% of your borrowings to the yen over what period of time?
Not yen really. The kind of mix that we create in the total mix, nearly 50% kind of thing we go for domestic bond. Another 20% to 25% we look for lending from the banks. And the next 25% we always try to have the ECB kind of mix. And dollar is also one of the preferred currency. We'll have a look on that also. But right now we have done our own calculations, and we feel that to start the ECB market, yen is a better buy for us, having all our experience in the last decade or so. Number two, we also came out with zero coupon bonds successfully in the market. In fact, we mopped up around 3,000 crore. We are the first in this calendar year, which is ending now, to successfully have mopped zero discount bond, which came out at 6.8%, nearly 35 bips discount to the domestic bond rates. So we are on now on our targets of mopping up funds for disbursement, which is picking up for my company.
Speaking of disbursements, sir, let's talk about the business overall. If you could just tell us now, how strong is the second half looking? Where do you finally think you'll end in terms of the overall growth of the book, growth in disbursements? And what is the plan of growing the newer segments? And you want to get into so many segments, logistics, sports, renewables, so on and so forth. So just give us some perspective.
So as we discussed in the last two con calls, after con calls when we came to CNBC, so we are on the right track. So what we spoke about, we are walking our talk. So end of the Q2 or H1, we first had a very healthy order book with us. We sanctioned and signed agreement for more than 50,000 crore of worth assets, all in the government parlance, including CPSEs and state government entities who are doing very well. And now we are focusing in S2 more on disbursement, as we have given a guidance of 30,000 crore disbursement in this FY, which we are right on track. So, and for precisely for that only, we are raising funds from the market, domestic as well as the foreign markets. So I reiterate our guidance that we will be ending up more than 30,000 crore of disbursement this FY. And so far as our guidance for 60,000 crore of sanctioned assets, we are already near to finishing that in this month itself. So we believe that by Q3 we'll be overshooting the target that we gave ourselves for sanction of the estimates. There are a lot many things, as you rightly mentioned, is coming in terms of metro railway assets, port assets, multi-modal transport assets, logistic assets. And we feel that with the kind of attractive rates that we are offering to the market in the government sector parlance, we stand to gain a lot of business coming ahead, maybe in Q4 as well as in the next 2-3 years. There is very clear-cut visibility of the businesses lying on the plateau.
And with this diversification, if you could just tell us, say end of, now this year is almost going to get over, but say end of FY27, what will your, asset book look like? What will be the mix? And as you keep diversifying, what should we expect on margins? How will the margins improve from the current levels?
So that is the most important and sweet spot that this company, as you rightly mentioned. All last 40 years we were doing business with Indian Railways on cost plus model where my margins was only 40 bips. Now the business that we're doing in diversified mode in the government ecosystem itself, my margins are more than 100 to 150 bips. So NIM is going to show continuous improvement every quarter, as I've been telling in all my con calls. We are already crossing 2% of NIM compared to 1.4 for the old assets. And we believe that with the margins that we are getting, despite being very competitive and bidding the bids where almost everybody, right from the banks to NBFCs are participating, because we historically had 40 bips margin business, 120, 150 bips margin is very good, and my NIM will be showing continuous improvement for 20-25 quarters, I can say.
So for your new assets, your NIM is already, you're saying, touching 2%. But at a consolidated level, your NIM is about 1.5%. Where will the net interest margin be by the end of this year, sir?
So, 90% plus of the assets are having a NIM of 1.3 to 1.4. So, on overall basis, my NIM will be growing in this line only from 1.4. We have come to 1.5. Maybe we end up at 1.6 or 6.5, 1.65 overall. But we have two segments now. One is the railways, where the NIM used to be 1.4, 1.3 to 1.4. Two, the new assets that we are adding, they will be having a NIM of more than 2%. So, taking two together, slowly, when the diversified assets will be having more of the percentage, overall NIM will be showing a very steep increase going forward. That is why I mentioned that for many quarters going ahead, my NIM will be showing a steep rise every quarter.
Okay. All right, we'll leave it there, sir. Thank you very much, and good luck on those borrowing plans and how the mix changes. We'll keep in touch. Appreciate it very much here on CNBC-TV18. Take a break. We're back. We put the focus back on the capital market space itself. K. Suresh of Association of National Exchanges Members of India and me, and Rajesh Baheti of Cross-East Capital Services join in. We reported yesterday that SEBI is working on a eligibility criteria, a paper around it for everyone to be able to access derivative trading, something which has come up in discussions earlier, but I think the thinking is firming up. We'll have both Rajesh and Mr. Suresh on it in just a bit. Welcome back. Now we are sort of shining the spotlight on the capital market space itself and derivatives trading. I mean, so much has happened, discussion papers, change in thinking over the last, 12 months plus. Sources now tell CNBC-TV18, and we put this out yesterday, that SEBI may tighten access to derivative trading with new suitability norms. There is also, one or two other things we want to talk about, but this is the crux of what we've invited our guests to talk about today. K. Suresh is National President at ANMI, the Apex Brokers Association. Rajesh Baheti is MD at Cross-East Capital Services. Gentlemen, great to have both of you here. Thanks very much for joining us. Rajesh, I remember, we've kind of talked about this earlier in the past, and correct me if I'm wrong, what I remember is you being in favor of something like this when there was talk of doing other stuff. You said maybe eligibility criteria perhaps is a better way to go about this. Your first thoughts?
Yeah, absolutely. Between the two, like tweaking of products or reducing the number of expiries and putting in an eligibility criteria, I was always favoring the eligibility criteria. But I think SEBI has gone on an overdrive to deny many rumors surrounding this after the changes they have introduced. And we clearly see that the exchange volumes have moderated, brokerage incomes have moderated. So I don't know whether this is the right time to go ahead and push for further reform or wait for the new data to settle, look at what's happening, and then probably come out with a paper. because even though SEBI has conducted a study that says that 90 or 95% of retail loses money, it's very important to understand what part of that retail it is. Are these the people who have no other savings and then these people are betting their salaries? Or these are the people who have other savings, have the necessary wherewithal to bear these losses? So I think they should do a little bit of a deeper study before coming out with a criteria that can hurt the market rather than target what they want to target.
I remember you having kind of sort of at that point when this was discussed, you had some certain threshold in mind. I mean, what you thought perhaps is appropriate, etc. But what you're saying is, well, this is the way to go, but maybe not the right time, given that volumes, etc., have already fallen after what is done, what has already been implemented, right? Maybe
Absolutely,
give it some
you
time.
need to give it some time, let the market settle, and then maybe understand what part of retail is actually losing money, and make sure that you're not targeting the entire market, because changing of the products and expiries targeted an entire market. It didn't kind of hit only retail or what they wanted to do. So this time you have to be very sure who your target is, and therefore what you're trying to reduce doesn't kind of hurt the market in other ways.
Yeah. No, in a related way, there is the other sort of aspect as well. Mr. Suresh, ANMI has written to SEBI on restoration of Bank Nifty weekly contracts.
Yeah.
So while we are talking about more steps, and Rajesh kind of says that, well, maybe now's not the time, you're asking to give what they've already done a relook. Restoring Bank Nifty contracts. Tell us what you've written to SEBI. What's the crux of the argument?
See, the argument is on many counts, actually. First of all, there's a disruption in the volume of business. As Mr. Bharati said, to the extent of 45% dip in the options volume, which indirectly or rather directly affected the broker's income. I think we must also keep in mind that broking also an industry. We are directly, indirectly giving employment to many people. We are also adopting technology. So that way, we are supporting the whole ecosystem. So here we have to see that the employment at stake because of revenue reductions. So we have to think from that angle also. Second thing is that Bank Nifty is one of the what I can say, best instrument available, that to weekly expiry for short-term hedging. It was available. When it was abruptly removed, what happens? Once again, there is a disruption in these strategies by the traders and others. I mean, you have to spend huge money if you take a long-term contract instead of going for a weekly contract. So like that, there is another disruption in these strategies of the traders also is there. NB always feels that there is room for educating the people instead of putting the rather making everything stopped. What we advocate is that we must educate the investors so that, particularly for F&O's segment, so that there will be an informed investors who will come and play and rather do something for their purpose. Otherwise, this will lead to a lot of problems. Once again, from SEBI angle, we are agreeing with them that 96% of the people are losing.
Mr. Suresh, is this just a letter? Have you had discussions with SEBI officials on this?
No, sir, yet to. Only we have sent a letter and we are yet to receive a call from SEBI on discussion.
Okay, it's just a letter, which went out about a month ago?
Yeah, roughly around 15 days, I think, 20 days back. 20 days.
Rajesh, you want to sort of comment on this? Because, I mean, all of Mr. Suresh's points, of course, are valid, but, there's also the larger picture which one is to take a call on, and I guess that's why regulators are there. I mean, I guess regulators were worried about this entire almost gamification with real consequences in the option space, weekly options, etc. So just your thoughts.
There are two issues to this. One was SEBI said one expiry per week per exchange. And then SEBI said one contract per week per exchange. If SEBI had just said that let's have one expiry per week per exchange, then NSE would have to, assuming that Bank Nifty was not removed from the weekly contracts, would have had to expire both the Bank Nifty and Nifty on the same day. And let's say I have X capital. and I want to use it on a 0-day or whatever SEBI is trying to stop. I only have that one opportunity 1 day a week on the NSE, and I can do it either on the Bank Nifty or Nifty. So to that extent, I think stopping the number of contracts was not such a great idea. Maybe you would have achieved exactly the same result by just saying one expiry per week per exchange. You can expire any number of contracts you want to during the same day, so that a capital can only be used once. You can either use it for this contract or that contract. And to that extent, I think would have had better diversification of risk across markets. So I agree with Andy that Bank Nifty can be reintroduced, but perhaps not on a separate expiry day. If SEBI wants to control the volumes, you have to merge it with the Nifty expiries.
Yeah, we haven't heard the last of it and whether, there will be some change on that or not, because the indication that one also got was that obviously the NSE, and we spoke with the NSE officials just earlier this week, they were saying that why not look at reintroducing Bank Nifty, because obviously it's a product that was very widely accepted in the market. So let's see what happens. But gentlemen, to wrap this up, if I were to ask you, because the objective is to reduce what the regulator feels is excessive and harmful retail speculation. But then, you have to keep brokers' interests in mind, stock exchange interests in mind as well. Raja, if I could ask you, if there is to be some sort of a threshold to limit, retail from indulging in what it doesn't perhaps really truly understands, what sort of a threshold should be thought of? Right now, they seem to be indicating that maybe, have a certain large cash position. Only after that can you enter into F&O. I don't know if that's the right approach. How should this be done?
I think the discount brokerages will be having the data to understand what's the lowest rung of the market that is trading in F&O. Do they have equity savings or not? I would just kind of speculate and say if you could bring in a criteria that says you must have 5 lakhs worth of capital market savings and either by way of direct equities, mutual funds, or whatever, And then if you maintain that, you can trade in the F&O. Perhaps the lowest rung that doesn't have savings but just bets his daily or weekly or monthly salary on buying options on expiration days and treats it as a lottery, maybe that can go out of the market. If that is what the aim is, then this would work better than restricting products. And I've said that for some time, that given a choice between the two, I would have gone for this product suitability or some kind of a savings in your bank before you were able to do this.
Yeah,
but you've done the other bit.
So don't restrict products, maybe bring in a threshold. Say you have an actual underlying cash portfolio of a certain level, and only after that you can get into F&O. Though I don't know if that really meets the objective, because it's not like that underlying cash portfolio is or can be used as collateral or margin. Not necessarily, may or may not be the case. Mr. Suresh, final word with you. What would you recommend? What kind of thresholds will be palatable to the broker community?
See, actually, there was an apprehension earlier that Bank Nifty is manipulated, etc. Okay, now a realignment has happened to that index. Okay, so it's well balanced now. So the room for manipulation gone. So when there's no room for manipulation, nothing wrong in introducing that. From broker's point of view, mainly, the income already reduced a great extent, and it has affected the functioning of every broker, particularly large brokers also. So from that angle, the employment also at stake for various, the manpower, rather, we are losing many people employment in that segment. As we argued many times back, many years back, that we need industry status for broking actually, because we are directly, indirectly contributing to the economy of the country. So from that angle, my view is that reintroduction of Bank Nifty is a must for bringing back the necessary hedging instrument, as well as bringing up the volumes and also providing another variety of product for the investors as well as for the other players in the market.
Okay. All right, gentlemen, we'll leave it on that note. Let's see what the final rules and guidelines and what's the final structure of the policy as it evolves. Thank you for joining us today. Well, with that, let's get back to the market and get you some trades at 10 o'clock. The market's actually recovered. We're seeing some green on the screen now, 45 points up on the Nifty. And the mid-cap index is actually doing even better, up about 0.3%. Somil Mehta is joining in. He's from Mirae Asset Share Khan. Somil, morning. So what are your trades now?
Good morning to everyone. My trades would be in banking, private banking, and on the IT side. Both sectors are looking great. I will focus more on the large caps. I have ICICI Bank. ICICI Bank's looking good. Taken support at 2040 and 200 daily moving average. Showed very good momentum yesterday. I think this rally should continue. Stop loss would be 1350 and the target would be 1500. My second stock is from the IT pack. IT pack is doing really good. TCS has just broken out of a triangle pattern. High top, high bottom formation on the weekly charts as well. Great setup. Stop loss would be 3120 and target would be 3500.
Okay, all right. Thank you for that. Somil, we'll leave it on that note. Let's move on to some stocks that are active, that are buzzing around right now. Petronet LNG is one of them. Sonal is here with more details. Sonal.
Well, yes, Petronet LNG higher in trade on the back of an execution of a binding term sheet that they've entered into with ONGC. This is for 15 years and it will include ethane unloading, handling and services as well. Petronet LNG says it will have a gross revenue potential of 5,000 crore rupees over the next 15 years. Nomura on the back of this is quite positive on the stock. They have a target price of 360 rupees a share with a buy rating. They say even if they assume a conservative EBITDA margin of 60% on this particular deal, it would mean EBITDA potential of 140 crore rupees in the first year and 15th year EBITDA would reach around 275 crore rupees. This is as per current estimates of 60%. It could go higher as well if margins improve. So yes, it is a good deal that they've entered into, which will lead to EBITDA accretion going forward.
Okay. All right, Sonal, thanks so much for that. Well, with that, let's move on to the other big story, and that is the aviation mess that we've seen at major airports over the last 1 or 2 days. Major disruptions following flight cancellations largely by Indigo. We have Shivani joining in with the latest details. Shivani, what's happening now?
Yes, big disruptions across the country now. Indigo has seen a lot of flight cancellations, and what we are getting to know from sources at the Bangalore airport now is that since 12 a.m. This morning to right now at around 8 a.m., close to 72 flights have already been cancelled, and this number is going to go up during the day when we look at major airports, which is Delhi, Mumbai, Hyderabad, and Bangalore. So let's keep a track on how many flights are cancelled. And as I mentioned before as well, the delay timings are averaging around 5 to 6 hours at major airports. So this is like a nationwide disruption now. In what happened last evening, DGCA, the authority, has summoned Indigo Air and has asked them to present themselves in front of the authority and explain what has caused these delays. So we'll have to keep a check on what happens during the day, because these cancellations are going to increase today as well, because Indigo has said that it will take 48 hours to control the situation and manage the situation. So this is a developing story.
Okay. All right, Shivani, and we'll keep coming back to you for more updates. It is indeed an important story. Right now, we'll take a break. On the other side, Manisha Gupta joining in with the latest in the commodity markets. Welcome back. So as promised, let's figure out what's happening in the commodity markets. And we have Manisha Gupta with the latest. Manisha, what do you have your eye on?
Well, metals, and I want to talk about two metals which have hit all-time highs in the overnight markets. One is silver, which is trading at around 58.98, which is an all-time high. So 59, consider that almost done, and $60 an ounce is what the markets are watching out for right now. If you look at the overall gains in this year in the dollar terms, well, we are up by 103% for the silver prices. So the prices have doubled up from where we started 2025 there. Well, the markets are now working with the probability of almost 90% of a US Fed rate cut in the month of December. December. That seems to be baked into the prices right now. And then you have the US private payrolls, which fell by 32,000 jobs. Markets were anticipating a jump of 10,000 jobs here. So not only did we not see any gains, but it is a sharp decline that we've seen in sense of job numbers there. Also, silver-backed ETFs have added 200 tons on December 3. The total holdings now stand at a 2022 highs. So this is something that was missing really, because the markets thought that ETF buying had peaked in 2022, but we seem to be closing to those numbers right now. The other thing is the record volume of silver, which seems to be moving to London in the month of November. Well, the Shanghai inventory is trading at the lowest in last 10 years. All of these factors have led silver on the higher side. I want to show you on what silver has done in sense of top yearly gains since 1979. And that was the year we saw silver prices gain up by 360%. So 2025 in that sense is the second best year on record, with 103% of gains coming in. And the other best years in that sense have been anywhere between 40 to 80%. So this year clearly on the stronger side there. This is in the Indian rupee. So if you have seen 103% of gains in silver in the US dollar terms, because of rupee depreciation in the Indian rupee markets, we have seen 112% of gains come in for silver this year. Last year was 87,000 rupees. Currently, we're trading at 1,84,000 rupees. So that's clearly a doubling of silver prices that we have seen. And this is what we've seen in last many years. Barring 2021, the last 5 years actually have given you positive returns when it comes to silver prices. And as you can see, doubling in case of silver prices, 112% of gains in Indian markets for silver in this year till time. And we still have much of December left there. The other commodity I want to talk about is copper. That also has hit an all-time highs in the overnight markets. 34% of gains in 2025 till time, and all-time high has been $11,400 a ton. Well, there have been warnings of low global inventories coming in from companies, agencies, banks and brokers as well. And then you have large quantities of copper being shipped into US in anticipation of tariffs going forward. The producers also have announced record premium to their customers in Europe and Asia, and that has been keeping prices much higher with this part of the world. If you look at the mine outages that we've seen in Chile, Indonesia, Congo in this year, that have led to gains in copper prices. And then even now, as we speak, the Chinese smelters and miners are locked in conversation about supply for 2026. All of those factors clearly very supportive. And then when you look at the overall orders for copper, they are the largest since 2013. So whichever way you look, that is whether it's about demand, supply, inventory, mine outages, copper perhaps is the place to be.
Okay, all right, Manisha, thank you very much for that. We'll take a quick break on that note, come back on the other side, and we'll have our special segment, It's the Economy. Today, Lata discusses the outlook on the Indian rupee with Kamaksha Trivedi of Goldman Sachs.